Hi, Steve Van Metre here, and welcome to your Monday night premiere where we take about 15 minutes, maybe a little longer tonight, to try to make sense of markets that, yes, I think today they make sense to me. And you know, I'm really irritated at my profession on days like today. I had to go down to Los Angeles this morning, take my wife to a surgical post-op appointment. For those of you who know, good news, doctor said she may not need another surgery. Could, but at least right now, maybe not for a couple years or more, which is great news. Her attitude was like, woof, like bond prices these days, woof, straight up. Very, very excited. So thank you for all those who've asked and for your prayers. Appreciate that. And of course, I knew what was going on with the markets. I saw the futures last night. I was kind of watching, while we're waiting for the doctor. I had my laptop out, kind of watching what's going on. Obviously, could not do that while I was driving home. And I turned on a financial radio show on the way home just to kind of get the pulse of what my people think about this, which, again, there's a reason I beat to a different drum. I don't like a lot of the way my industry handles things. But here's what I heard on the radio. Don't worry about losing money. The markets go down. Well, it was overvalued. You do know that. It had gone up way too much. And you are a long-term investor, right? I mean, remember that risk tolerance questionnaire said that you had a 10-year time horizon? Well, things do go down. And let me tell you what irritates me about this. If the stock market was overvalued, which it is, why weren't they doing anything with their client portfolios? They weren't. Look, I don't care if you're a short-term, mid-term, long-term investor. Nobody likes losing lots of money. Nobody. And yet, how hard was it to have raise cash over the last 12 months, add some treasuries to the portfolios, or like some crazy people, overload their clients with treasuries because they knew the bond market was signaling there was going to be a major correction in the market. So I wasn't worried. In fact, I slept pretty good last night, all things considered. I was in a hotel room because I had cash, clients that had cash, hedged portfolios with treasuries, and a bunch of clients that were heavy in bonds and making money. And yet, what irritates me is that people were patting their advisor on the back all last year. Man, great job making me all this money, man. You're just the best. Do you realize that your financial advisor has now probably made more money than you in the last couple of years in their fees? If you go back and look at where the market is now versus where it's been the last couple of years, your advisors made more money than you. And what are they telling you? Oh, you're a long-term investor. You're a high risk, remember. It's okay. Markets go down. They roll around. And that's what irritates me is they weren't doing anything. And what do they say? Oh, it's the coronavirus. Look, it's not just the coronavirus. Yes, it is causing global supply chains to slow down, lock up. And yes, that is a problem. What happened this weekend that nobody seems to be paying attention to? OPEC. And what happened at the OPEC meeting? Russia said, we're not going to cut. And Saudi Arabia said, okay. You got a lot of financial problems from what we can see from over here. So how would you like it if we turn the pumps up? And oh, by the way, you shale producers over America, we're sick of you too. See, this is a dollar liquidity shortage issue that I've talked about. See, the world is short dollars. How do countries like Saudi Arabia get dollars to pay their dollar-denominated debts? They sell one thing, crude oil. And then finally, the rubber has met the road. And so what did they do? They said, we're going to increase production next month by 300 barrels a day and tried to go up to 2.3 million barrels a day as we get things turned up. We're going to put Russia out of business. We're done. We're going to put shale out of business. Probably put shale out of business first. So why does the market have such a negative reaction? Even though you can turn on any financial news show, the market is still in a bull trend. Hey, do a chart of crude oil against the U.S. economy. And you'll see when crude oil prices go down, guess what happens to the U.S. economy? It goes down too. And so do stock prices. And so guess what? People over the weekend got their clocks clean. They were short bonds and they were long oil. Whoops. Oh yeah, they were long stocks too and short volatility. Whoops, 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 whoops. Unwind selling, and that is why things started to unwind, and they're not going to get any better. Let me tell you what's happening in the oil industry today. The banks are calling their oil client customers, these oil, small, mid producers who have borrowed lots of money. And they're calling them to find out how they're going to get their money back because, now I don't know this for an absolute fact, but I'm 99% sure this is happening today. Do you know what no bank has priced into these loans that they gave to all these oil companies? Yeah, $30 barrel oil. They didn't have $40 a barrel priced in either. And now they're calling to say, what are you going to do to make sure we get our money back? And you know what that means? Layoffs are coming. I know they were, and more of them are coming. And these are not low-paid, part-time, minimum wage jobs. These are high-paying, overtime jobs with full benefits, and people are spending money. That is what the economy or the stock market was reacting to last night, because Saudi Arabia is going to flood the world with oil and put people out of business. And if you don't think they're going to be successful, oh, they are. And so does the stock market. So we got a big unwind today. People were panicking because they weren't hedged, they didn't have cash, they didn't see it coming, because most financial professionals just literally sell a portfolio that someone else manages and they collect an override fee for it. They don't know what's going on with it, and they don't care. All that matters is your risk tolerance. So let's go and see how some people were positioned, such as hedge fund managers. One of my favorite things to look at every Monday, thanks to hedgeopia.com for posting this stuff for free. And as of last Tuesday, guess what? Hedge funds were still net short. This is like Christmas time for people that own bonds. Because now, remember when I said bonds prices or yields will not bottom, bond prices won't peak until hedge funds are net long? They're not net long, not on the 10-year. This is telling you the 10-year is going negative. How about the 30-year? Oh, they're still net short here. This is telling us the 30-year is probably going to get close to zero. Cha-ching. This is great news. How about crude oil? Well, as of Tuesday, and you can see they really got their clocks clean today on this deal, is they were long crude. And now this is down here at 30 a barrel. And yes, I do believe this is headed toward 20. There's just, the coronavirus isn't causing all the problems. It's just taking demand away that was already weak. So S&P 500, they're virtually net flat on that. Nothing exciting there. How about gold? I'll tell you, gold gets sold off. I will show you today. Gold gets sold off when volatility spikes. Volatility, it's on the cusp of exploding. They're long the NASDAQ. Guess what? NASDAQ's way down. And tomorrow, you're going to see quantum computers selling. Whoopsie. That's going to happen. How about Russell 2000? Small caps tanking. They're long there. That's not good. The dollar's, I'm still surprised the dollar's tanking in the midst of a global dollar shortage, but the hedge funds are on the wrong side of that trade too. I thought, you heard me say, I thought they were on the right side on this one, but I guess I was wrong. And volatility, which is high and rising, remember, it doesn't peak until hedge funds have endured maximum pain. Now you might be like, well, Steve, you seem to be happy about this. Well, look, if you were in stocks, if I was in stocks, I'd be really sad, but I'm not. So let it ride, Because here's the thing that most people are saying. They're saying, look, the market's oversold. Yeah, you know what computer programs don't care about? Oversold. They don't care. Because a computer program has a formula that says when volatility rises and other things go down, we sell them. So I suspect that after volatility sitting up fairly high now for the last 5 or so trading days, that more of these computers programs should sell tonight. And we already know there's going to be some selling tomorrow. And then we still have the Fed yet to go to zero. And we know when the Fed is cutting, it's tightening financial conditions, driving interest rates lower, making easy money for people that own bonds. I gotta love this stuff. Because I've been saying this is going to happen. I've been saying for years, you're going to see the computers sell into an illiquid market and chase each other down. Let's take a look at some charts. And here you go. S&P 500, in a matter of not many trading days, has gone all the way back to virtually where it was in January 2018. So anyone who bought in January 2018, their financial advisors made more than them. Anyone who's bought in March of 2018, or how about in here? June, July of 2018, or maybe they bought in November of 18, and perhaps they bought here late May of 2019. Congratulations. If your financial advisor let this happen, they've made more money to you than you did. And here's the thing. Rate cuts are bullish. 1, 2, 3, 4, 5. Nope. Told you, rate cuts aren't bullish. But yet people still believe. And now they say interest rates can't possibly go any lower. They can't go any lower. And that's why people are still shorting the bond market, because they don't realize how the bond market works. And yet, what did I tell you? This is the largest topping pattern in 10-year Treasury yields in the history of 10-year Treasuries. And look what happened. I don't know if this is not the exact closing value, but we'll just say it's a little over 0.5%. And the answer is, well, who would give their money to the federal government for 0.5% a year for 10 years? People don't. Look, you understand that banks and other players have to hedge positions? This is a hedging position. That's the beauty of it. All these programs that are sitting heavy in stocks that are going to be forced to sell, what are they going to buy? They're going to buy bonds. See, I knew this. That's why I bought bonds so long ago, because I knew who I would eventually sell to. I'd sell to everybody when they were going to be at zero or negative yields. And if you don't believe it's happening, I mean, you can literally see it right here happening right now. And so we do expect the Fed to cut in a couple of weeks. And, oh, you know what? There was a question. I forgot. I got a question today, a really good one, that says, I'm hearing in the financial media, the Fed, and we're hearing from Fed people that they need to buy stocks. Can they do that? The answer is no, they can't. The Federal Reserve Act of 1937 says they cannot purchase stocks. So that means Congress would have to overturn the Federal Reserve Act. Well, one, they're not going to do that in an election year. Not going to happen. Number two, if they were going to, this is going to sit in Congress for years, because nobody wants to be stupid enough to vote for this thing and then hyperinflate the dollar. Because the moment you undo the Federal Reserve Act and the Fed starts to print, you hyperinflate the dollar and you will crash the global financial system very, very quickly. It will not take long. So the answer is no, the Fed can't buy stocks. The closest thing we've seen to the Fed buying stocks is the U.S. government giving corporations a 20% tax cut that they didn't need so they could buy their own stock back. And that's what you're seeing, this big increase in government debt. That's the closest thing we can do, is give corporations more tax cuts and hope they buy more stock back. Of course, you have to have, a profit to get a tax cut. Well, the economy is slowing down, and slowing down quick. So let's take a look at, when we look at TLT, people say, well, look, all these people are selling here. Yeah, look, everybody is going to sell this thing because they think that this is like a stock, this is a blow-off move, and there's no way this can go higher. It can, because the Fed still got 1% of the federal funds rate to go to zero. The Fed's going to increase their bond purchases probably. And all these people that are sending in stocks that have no control of their portfolio are going to shift to bonds. So yes, this can keep going higher despite the fact that everyone says it can't. Now let's take a look at EEM, because we are right on the line of doom that I've talked about with emerging markets. And what happens is when you get to the shaded gray bar, and it's hard to see, but here we are today right in the middle of it. This means volatility is spiking. If we see a sell-off here and emerging markets continues to go under this bar, you're going to see a massive unwind in stocks. If it can recover here, then you've seen now the bottom. I don't think we've seen the bottom, and I'm going to show you what happens. Let's overlay the VIX volatility index. And here you can see every time it gets in this shaded gray zone, we see, I'll mouse over it, you can see it spike there. So we are setting up now with volatility as high as it is, volatility sitting way up here. You can see in the great financial crisis it got here. It's suggesting that if there is any more selling, things get bad. Now let's say, what does that mean for bonds? Well, it means bond prices go higher, because look what happens when volatility spikes. Bond prices go higher and higher as interest rates go down. That's how you know where you can sell this thing. And we're not there, because I don't think volatility is done. Now, normally we should be done. I don't think we are, because what happens when you suppress volatility, it's like a spring. You suppress it. The longer you suppress it, the bigger the spring's back. As I've told my wife, what that means is the stock market will explode, implode, and then go supernova on itself when this thing gets out of the bag. And we are this close to it happening. We're this close to having a major credit crunch and an explosion of the markets. And people say, I don't want to own bonds. You're crazy. Unless you think that this is the end of it. And what did we have to see? We had to see the coronavirus going away. It's not. And now you tack on this oil issue? No chance. No chance. So what's going to happen to stocks? Well, they're going to get unwound. They're going to explode, implode, and then go supernova on themselves. See, when volatility eventually spikes, this beginning move here gets exaggerated all the way down. Remember I said wait to buy, I wanted to buy gold miners, but I wanted to wait. Look what happens when volatility hits gold stocks too. It usually when they're up, they usually end up going down. They usually finish their sell-off somewhere following that. Again, no point to rush. There's big opportunities to come. So let's see what else is worth looking at. We got to look at oil stocks. Talk about bad things. Remember, I said Exxon was in big trouble, leading the market down 12% today at 41 a share. Didn't I say it was going to get down to around 40 a share? Boom, there you go. And it's probably not done yet. This is going to be a super big opportunity in the big majors. How about Chevron down 15%? What did I say? It would get down here to 80. Remember? And this was kind of like the final stand between 75 and 80 right in here. Guess where it's at? Headed lower. Not good. How about Boeing getting trashed? How about FedEx? Goodbye. I mean, this whole market is just getting unwound like crazy. So if there is a big unwind tomorrow, I might do another video just to, because I said I might do that a long time ago and I didn't tell you, but I might. So I might be back tomorrow, maybe Wednesday. Until then, I'm Steve Van Metre. Thanks for taking the time to watch. Hopefully you've taken some of this advice and not gotten caught up in today's big downdraft. I'll see you maybe tomorrow. If not, Wednesday for sure. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or other advice. This channel is not to be construed as a recommendation or solicitation by a security, financial instrument, or pursuing any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. The opinions expressed in the video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.